37.6 million ounces vanished from COMEX vaults in 47 days. That's not market fluctuation. That's a silent run on the bank. While everyone watches gold, central banks are executing the most significant pivot in modern financial history. They've shifted from net sellers to net buyers of silver for the first time in decades. This isn't speculation, it's a signal. A final confirmation that we are now in the closing phase of a historical pattern that has governed every major commodity crisis for over a century. The outcome is no longer a matter of opinion. It's mathematically inevitable. This is not prediction. This is pattern recognition. There's a four-stage mechanism that governs every commodity supercycle in history. I'm going to prove this pattern to you 3 times with historical examples. But first, you need to understand the mechanism itself. Because once you see it, you can't unsee it. Stage 1 is where it always begins, the structural deficit. This is when industrial demand for a critical commodity permanently outstrips the available supply. The mines can't produce enough. The recycling streams can't keep up. The deficit begins quietly, hidden in plain sight within industrial reports and supply chain data. For silver, this stage started years ago, driven by solar panels, electronics, and the electrification of everything. The demand is inelastic. A car manufacturer can't decide to use half a catalytic converter. A solar panel factory can't skip the silver paste. The need is absolute. Stage 2 is the great inventory drain. To mask the growing structural deficit, the system begins to consume its own buffer. The vaults, the COMEX, the LBMA start to empty. This is the market's emergency reserve, and it's being liquidated to create the illusion of balance. It's like a game of musical chairs, where the chairs are being removed one by one, but the music is still playing. Participants don't realize the cushion is gone until they try to sit down. For silver, this drain has been accelerating since 2021. The registered inventory, the metal actually available for delivery, has been collapsing. Then comes stage 3, the divergence. This is the most critical and deceptive phase. The paper market, the futures contracts, the ETFs, the derivatives, completely decouples from physical reality. The price on your screen becomes a fantasy, a digital promise backed by nothing but leverage and faith. The paper market can claim there are billions of ounces available, but the vaults tell a different story. This is where we see the cracks. Backwardation, where spot prices trade above futures prices, screaming that the market is stressed. It's a signal that people would rather have the metal today than a promise for tomorrow, even if they have to pay a premium. We are at the peak of this divergence right now, and that leads to the final explosive stage. Stage 4, the dislocation. This is when physics overrules finance. When a major industrial user, a sovereign nation, or a massive fund goes to collect their metal and the vault is empty. The paper price detonates. It doesn't gradually rise. It gaps up violently to find a new equilibrium price that reflects true physical scarcity. This is not a slow-moving bull market, it's a systemic reset. Silver is now transitioning from stage 3 to stage 4. The central banks, the most risk-averse entities on the planet, are not buying because they think the price will go up. They are buying because they know the system is about to break. They are insulating their balance sheets against the coming dislocation. This pattern has played out with oil, with palladium, with grain. The actors change, but the mechanism is a law of economics. You are watching the final act of a play that has been performed many times before. The script is written. The actors are in place. The outcome is certain. So let's start at the beginning. Stage 1, the silent structural deficit. This is the foundation of the entire crisis. A structural deficit isn't just a temporary shortage. It's a permanent ingrained gap between how much of a critical commodity the world needs and how much it can actually produce. It's a math problem that cannot be solved by higher prices alone because the supply is fundamentally inelastic. For silver, this deficit is being driven by 3 industrial engines that show no signs of slowing down. The first is solar power. Every single solar panel requires a significant amount of silver paste for its conductive properties. As governments worldwide mandate a transition to green energy, the installation of solar capacity is exploding. This demand is not optional, it's policy-driven and massive. The second engine is electronics. From every smartphone and laptop to the entire 5G infrastructure being built out, silver is an irreplaceable component. Its conductivity is unmatched, and the third, and perhaps most powerful engine, is the electric vehicle. An EV uses substantially more silver than a conventional car, sometimes double or triple the amount, in everything from the battery management systems to the charging infrastructure. Now, against this tsunami of demand, what does the supply side look like? Stagnant, silver mining output has been flat for nearly a decade. There have been no major new silver discoveries. Existing mines are seeing declining grades, meaning they have to process more rock to get the same amount of metal. The lead times to bring a new mine into production are 7 to 10 years, minimum. Even if the price of silver doubled tomorrow, it would take the better part of a decade for that new supply to hit the market. The recycling stream is also limited. You can't effectively recover the microscopic amounts of silver dispersed through millions of electronic devices. This creates a permanent gap. The deficit isn't a forecast, it's a present-day reality. Industry analysts have been reporting annual supply deficits for years, but the price hasn't reflected it. Why? Because the market has been living off its savings. It's been consuming the inventory that was built up over decades, masking the true severity of the situation. The structural deficit is the slow-burning fuse. It ensures that no matter what happens in the paper markets, the physical metal is being consumed at an unsustainable rate. The system is running a deficit, and like any entity running a deficit, it will eventually hit a wall. That wall is the exhaustion of above-ground inventories, and that leads us directly into the next stage. This is stage 2, the great inventory drain. This is how the system hides the structural deficit from the average investor. The world's major commodities exchanges, primarily the COMEX in New York and the LBMA in London, act as the market's central nervous system. They don't just set prices, they hold vaults of metal. This metal, especially the registered category, is the buffer. It's the oil in the engine, the ready-to-ship inventory that allows the paper market to function smoothly. It creates the illusion of liquidity and abundance. For years, when industrial demand exceeded mine supply, the difference was made up by drawing down these vaults. It was an invisible subsidy to the global economy. But you cannot drain a finite resource indefinitely. The data is unequivocal. Since 2021, the drawdown has accelerated into a collapse. 37 million ounces gone in 47 days is not an anomaly. It's a trend. Registered silver inventories on the COMEX have fallen to multi-decade lows. The buffer is vanishing. This is the musical chairs analogy I mentioned earlier. The music is the steady hum of industrial consumption and paper trading. The chairs are the bars of physical silver in the vault. For years, there have been enough chairs for everyone who might want one. But now, chairs are being removed from the game one by one, sold to factories to be turned into solar panels and circuit boards. The players, the paper traders, are still dancing, focused on the screen price, not realizing the number of available chairs is critically low. They assume the chair will be there when the music stops. That assumption is about to be tested. The critical point here is the difference between eligible and registered silver. The total vault number often includes eligible silver, metal that is stored but not for sale, held by ETFs or investors. That metal is not part of the market's liquidity pool. The registered silver is what matters. It's the metal that is pledged for delivery against the futures contracts. That is the number that has been eviscerated. When that number gets too low, the entire mechanism of the futures market, which is built on the promise of physical delivery, breaks down. The leverage in the paper market is astronomical. There are hundreds of paper ounces for every single physical ounce in the vault. This works perfectly until someone actually asks for the metal. The drain isn't a secret, it's publicly reported data. But most people don't look at it, and those who do often misunderstand its implications. They see a price that isn't moving much and assume everything is fine. They don't see that the foundation of the market is being hollowed out. The drain is the undeniable proof that the structural deficit is real. The market is eating its seed corn, and when the inventory is gone, the only thing left to balance supply and demand is price. A price that must rise to a level so high that it destroys demand. That level is not $30 an ounce. It's not $50 an ounce. The equilibrium price for a commodity in a true physical shortage is always a multiple of the artificially suppressed price. The great inventory drain is the countdown clock, and we are in the final seconds. And that brings us to the heart of the deception. Stage 3, the paper versus physical divergence. This is where the real disconnect happens. The market you see on your screen, the one that trades millions of ounces per second, is not the physical market. It's a paper market, a derivative market built on promises. A futures contract is a promise to deliver metal at a future date. An ETF share is a promise that somewhere a bar of metal is being stored on your behalf. This system creates an illusion of almost infinite abundance. The leverage is staggering. For every single physical ounce of silver sitting in a COMEX vault that is available for delivery, the registered stock, there are hundreds of paper ounces represented by futures contracts and ETF shares. This works as long as almost no one ever asks for the actual metal. The system is designed for cash settlement, for rolling contracts forward, for trading promises. It's a confidence game. But that confidence is predicated on the unspoken assumption that if you really, truly needed the metal, you could get it. That assumption is now being tested. The clearest signal of this stress is a condition called backwardation. Normally, in a healthy market, the price for future delivery is higher than the spot price. This contango covers storage and financing costs. But when the market goes into backwardation, the spot price trades above the future price. This is irrational from a financial perspective. It means people are willing to pay a premium to get the metal right now instead of waiting, even if it costs them more. They are effectively saying, I don't trust the promise of metal in 3 months. I need it today. Backwardation is the market screaming that the physical supply chain is broken. It's a red alert that the paper price is a fantasy. Right now, we are at the peak of this divergence. The paper price is being held in check by massive short positions and algorithmic trading, creating a lid on volatility. But beneath that lid, the physical market is tightening every single day. Industrial buyers aren't bidding on a screen. They are calling their suppliers and taking delivery of truckloads of silver paste and grain. They are paying premiums over the spot price that never show up in the financial news. This is a two-tiered market, one for paper and one for reality, and the gap between them has never been wider. The entire paper edifice is built on a single, fragile premise that the physical metal will always be there to back up the promise. But what happens when a major player, a sovereign wealth fund, a giant industrial conglomerate, decides to stand for delivery on a large futures contract? What happens when they call the bluff? The exchange has to scramble to find the metal. If the registered inventories are nearly empty, they have to convince someone else to sell their metal, which requires offering a much higher price. This is the trigger. This is the moment the paper price, which has been artificially suppressed by leverage, snaps back to reality. It doesn't gently rise to meet the physical price. It violently gaps up to close the divergence. The paper market is a dam holding back a reservoir of pent-up physical demand, and the dam is cracking. This brings us to the single most important confirmation that stage 4 is imminent: the central bank signal. For generations, the official narrative has been that central banks hold gold. Silver was considered an industrial metal, a poor cousin, something to be sold from reserves, not accumulated. Their behavior has been consistent for decades, net sellers. But in 2023, and accelerating into 2024, that behavior has done a complete about-face. Central banks have become net buyers of silver. This is not a minor data point. This is a 5-alarm fire for the entire financial system. Why? Because central banks are not hedge funds. They are not speculators trying to make a quick profit. They are the most conservative, risk-averse institutions on the planet. Their primary mandate is stability, the stability of their national currency and the stability of their economy. They move with glacial slowness, and their actions are based on long-term strategic analysis, not short-term price movements. When they pivot this dramatically, it is because their models are screaming that a fundamental, systemic shift is underway. They are not betting on a price rise. They are insulating their nations against a systemic failure. So what do they see that the average investor misses? They see the completion of the 4-stage pattern we just outlined. They see the structural deficit that cannot be reversed. They see the inventory vaults that are nearly empty. They see the dangerous divergence between paper promises and physical reality, and they understand the inevitable conclusion: a dislocation where physical settlement fails. For a central bank, the ultimate nightmare is not a falling currency value. It's being unable to procure critical industrial commodities needed for their nation's economic survival. Silver is not just a monetary metal to them anymore. It is a strategic industrial asset. It's essential for their own green energy transitions, for their technology sectors, for their military applications. They are not buying silver. They are buying industrial security. This pivot is the most reliable signal you will ever get. These institutions have access to data and intelligence that we can only dream of. They are not reacting to headlines. They are acting on the raw numbers from the mines, the smelters, and the exchange vaults. Their accumulation is quiet, deliberate, and massive in scale. They are using mechanisms designed to avoid spooking the market, buying directly from refiners, and through proxies to prevent the price from exploding before they have completed their accumulation. They are front-running the inevitable collapse of the paper market. Think about what this means. The very entities that oversee the financial system are now positioning themselves on the opposite side of the paper market. They are taking physical metal off the table, making the physical shortage even more acute. They are, in effect, accelerating the countdown to stage 4. Their actions prove that the paper price is a complete fiction, a temporary artifact of a broken pricing mechanism that is about to shatter. When the people who print the money start aggressively accumulating a hard asset that the market claims is abundant, you have your answer. The debate is over, the pattern is complete. The central banks have shown their hand. They are preparing for the moment when paper contracts become worthless promises, and the only thing that matters is what you can hold in your hand. Their silent accumulation is the final, undeniable proof that the largest wealth transfer in modern history is beginning. They are not just participants. They are the great canaries in the coal mine, and they are telling us the air is about to run out. But this isn't just theory. I told you I would prove this pattern to you with historical examples. Let's start with the most famous one, the 197's oil crisis. This is the textbook case of the 4-stage mechanism playing out on a global scale. It's a perfect parallel for what's happening in silver right now. Stage 1 began in the late 196s. The structural deficit was U.S. oil production peaking, while global demand, driven by post-war industrialization, surged. America could no longer be the swing producer for the world. The supply cushion was gone. Stage 2 was the silent drain. U.S. strategic petroleum reserves and global inventories were drawn down to mask the emerging gap. The system was living off its savings, pretending everything was fine. Then came stage 3, the divergence. The paper market, dominated by the major oil companies and futures contracts, maintained an illusion of stability. The price was managed, held artificially low. But the physical reality was different. OPEC, acting as the central bank of oil, saw the vulnerability. They recognized that the West was dependent on their physical supply. And then, the trigger, the 1973 Arab-Israeli War. This was the moment a major player, the OPEC nations, decided to call the bluff. They enacted an embargo. They weaponized the physical supply. This was stage 4, the dislocation. The paper price of oil, which had been around $3 a barrel, detonated. It didn't double, it didn't triple. It went to $12, then eventually to $40. The global economy was thrown into stagflation. The price didn't rise to curb demand. It exploded because the physical oil was simply not available at the old price. The leverage in the paper market was obliterated by the reality of a tanker that wouldn't dock. The same 4-stage pattern. A structural deficit, an inventory drain, a paper physical divergence, and then a violent price reset triggered by a physical supply shock. The mechanism is identical. Now, if you think oil is too big, too geopolitical, let's look at a recent clean example from the metals world itself. The palladium squeeze of the late 2001s. This is a miniature, high-speed version of the exact same pattern, and it's crucial because it happened in a modern electronic market. Palladium is a critical industrial metal primarily used in catalytic converters for gasoline-powered cars. Its demand is incredibly inelastic. You can't make a converter without it to meet emission standards. That's stage 1, stage 2 was the inventory drain. For years, the market was supplied not just from mines, but from massive above-ground stockpiles from the Russian government. Those stockpiles were the buffer. And then, quietly, they stopped selling. The buffer vanished. The inventory was drained. Stage 3 was the divergence. The paper market for palladium, traded on futures exchanges, continued to function. But the physical market began to tighten dramatically. Auto manufacturers, who need the metal every quarter to keep their production lines running, started encountering difficulties sourcing spot material. The premiums they had to pay over the paper price began to spike. The paper price was lagging, held down by speculative short sellers who didn't believe the physical story. Then came stage 4, the dislocation. It wasn't a war this time. It was a simple delivery failure. The physical metal just wasn't there to satisfy the contracts. The paper price detonated. It went from around $500 an ounce to over $3,000 in a matter of a few years. The move was violent and relentless. The shorts were obliterated. The auto industry was forced to pay whatever it took to secure supply. The paper market had to reprice to the reality of physical scarcity. This is the perfect model for silver. Palladium is a smaller, more concentrated market, so the entire cycle happened faster. But the mechanism is identical: inelastic industrial demand, the exhaustion of a critical buffer inventory, a growing divergence between a lagging paper price and a tightening physical market, and then a final explosive price move when delivery fails. Silver's the same movie, but on a much, much larger screen. The industrial demand is broader. The inventory buffer was larger, which is why the drain has taken longer. But the outcome is dictated by the same economic law. Physics doesn't care about the size of the market. When demand exceeds supply, the price must rise until demand is destroyed. The palladium squeeze is the recent undeniable proof that this mechanism is not a historical relic. It is alive and well in today's financial markets. And it is now silver's turn. Now, let's go back further, to a time before futures exchanges and central banks, to prove this isn't just a modern financial phenomenon. This is a law of human economics. Look at the 19th century grain crises, particularly the Irish potato famine. The mechanism is identical, stripped down to its most brutal form. The commodity was the potato. For a large portion of the Irish population, it was the staple food. The demand was perfectly inelastic. You can't decide to only eat half your required calories. That's stage 1. Stage 2 was the lack of a buffer. The population was dependent on a single crop. There was no diversified food supply, no significant grain reserves to draw upon. The inventory buffer was non-existent from the start. Then came the trigger, the potato blight. This was the equivalent of a mine shutting down. The supply collapsed. Immediately, the system moved to stage 4, the dislocation. There was no paper market to create a divergence. The price of food didn't just rise, it became infinite for those without money. The physical reality was absolute scarcity. People starved because the food literally was not there. This extreme example proves the core principle. When a commodity with inelastic demand faces a supply shock, the price mechanism must adjust violently to restore balance. In this case, the price was human life. The market cleared through starvation. It's a horrifying illustration, but it demonstrates that this 4-stage pattern is not about finance. It's about physics and human need. The paper markets of today are just a complex layer of abstraction trying to manage this fundamental law. But the law always wins. The Irish famine, the oil crisis, the palladium squeeze, they all follow the same script because the underlying mechanics of supply, demand, and inelasticity are constants. Silver, as a critical industrial input, sits squarely in this category. The demand is not optional. So let's talk about the physics of what happens next. We've established the pattern. We've seen it play out in history. Now, what does the actual moment of dislocation look like in a modern market like silver? It's not a slow, steady climb, it's a rupture. The entire paper market is built on a fundamental assumption that the promise of metal is as good as the metal itself. This works until the moment a major player decides they don't want a promise. They want the stuff, This could be a sovereign nation completing its strategic accumulation. It could be a massive industrial user who gets a delivery delay notice from their supplier and panics. It could be a large fund that decides to take delivery on a futures contract as a strategic move. The specific trigger doesn't matter. The system's vulnerability is what matters. The moment that entity stands for delivery and the exchange cannot source the physical metal from its nearly empty registered vaults, the game is over. The exchange will have to declare a failure to deliver. This is the equivalent of a bank telling its depositors it doesn't have their cash. It triggers a cascade. Every other participant in the paper market instantly realizes their digital ounces are not backed by anything tangible. A mad scramble for physical metal begins. The price on the screen, which was being manipulated by leveraged paper contracts, becomes irrelevant. The only price that matters is the one being paid in the physical market to secure the last available bars. This is when the price will gap. It won't trade up $1, then $2. It will jump $10, $20, $50 in a single session, as trading halts are triggered and the algorithms short circuit. The paper shorts, who have been betting on stability, will be wiped out in hours, forcing them to buy back their positions at any price, which only fuels the explosion. The market will be in backwardation for months, with the spot price holding a massive premium over any future date, because no one will trust a promise for tomorrow. The 150 price target is not a random guess. It's a conservative estimate of the price required to destroy enough industrial demand to balance the market. At current prices, the deficit is permanent. At $150, certain marginal uses of silver become uneconomical. Some electronics manufacturers will be forced to seek alternatives. Some solar panel makers will reduce silver loadings. The price has to rise to a level that rations the remaining supply to only the most critical, high-value applications. This is the market's brutal but effective way of rebalancing. It's a fire that burns away the excess demand. This dislocation is a systemic reset. It's not a wealth creation event for paper holders. They will be left with broken promises and defaulted contracts. The wealth transfer will be to those who hold the physical metal. They will be the only ones who can deliver what industry desperately needs. The central banks see this physics equation clearly. They understand that in a failure of the financial system, the only assets that matter are the real ones: energy, food, and critical materials. Silver sits at the nexus of all three. The coming dislocation is not a possibility. It is the inevitable conclusion of the mathematical imbalance we have just traced through every stage. The physics of scarcity always wins. This is not a bull market. It's a systemic reset. The wealth transfer will be absolute. Physical holders will be paid whatever price industry must pay to keep factories running. Paper holders will face counterparty risk, the risk that the entity promising them metal cannot deliver. The window to acquire physical at these suppressed prices is closing. The music is about to stop. The time for debate is over. The pattern is in motion. Verify the data yourself. Track the COMEX registered inventories. Understand the critical difference between paper and physical exposure. This is about securing a strategic asset, not speculation. The central banks have shown their hand. The four-stage pattern is complete. Subscribe for the real-time analysis of the dislocation as it happens. The largest wealth transfer in modern history is beginning.